Jim highlights rising inflation, comparing it to the 1970s but noting differences. He explains two types of inflation: cost push and demand pull. Currently, cost push factors drive inflation, primarily energy and food costs, while consumer behavior hasn't escalated to fuel demand pull inflation. He links energy and food prices, showing their interdependence in the inflationary cycle. Despite signs of inflation, indicators like inverted yield curves and expectations suggest the Fed will act to curb it, potentially leading to a recession. Jim warns of potential surprises, indicating a possibility of a swift shift from inflation to deflation, contrary to market expectations that the Fed will smoothly control inflation without severe consequences.
And it catches a lot of people by surprise. They're like, wait a second, Jim. It's inflation. You just look at 2022 starting in January. It was kind of like 7%. Then it was, it's 8.1. It's 8.6, and else 9.1, which is true. That is the series. It is going up. So people extrapolate that. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s. And I'll explain why. Well, explain why right now. Because it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war. The price tripled, but it went from like $2 to $6. Okay, but percentage terms, that's a huge jump. But it was still $6, and then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Entol and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supply is choked off. If there's an embargo or there's a shortage of natural disaster, a lot of things, it's coming from the supply side and demand is inelastic. So you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described. And as I say, I lived through the 70s where I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course they're related. It's like, here's the energy, here's the food. To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractor. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, etc. So these things, as I say, are linked, but food prices are going up substantially. Two things you can't do without other gas in the car and food. You have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, better spend the money fast because it's losing value. And you see that in inflationary expectations and inverted yield curves. Come back to that because that's a really big deal. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping and people would be in a frenzy to buy stuff. They're not. And yield curves are not sloping, upward sloping. They're inverted. They're going down. That tells you that. And we also see this in inflationary expectations. Inflationary expectations don't drive inflation here and now. What does is inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. Their information rates tell you a lot about what people expect, what the yield curve is telling us, what inflationary expectations are telling us. And other factors are telling us is that, yeah, there's inflation now, but the Fed's going to kill it. And they're to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, sorry, I shouldn't say that kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price. And consumers are really bracing for this. Even Jay Powell said the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. But that's not priced into markets. The markets are kind of pricing in a squishy landing or soft landing or from the runways. They're not pricing in a really hard landing. And that is what we're going to get.
In a nutshell, Jim Rickards reflects on financial crises, mentioning the 1998 Long-Term Capital Management, LTCM, crisis. He highlights how crises, though unique, often follow a pattern. He outlines how the Asian financial crisis in 1997 spread to various countries like Thailand, Malaysia, Indonesia, South Korea, and Russia before culminating in the LTCM crisis. He shares his intense involvement in negotiating the LTCM bailout, illustrating the high-pressure environment during the crisis, even citing a memorable incident of receiving urgent calls in the middle of the night from the Italian finance ministry during the crisis period.
They kind of all look the same. I mean, they pop up in different places. In 1998, it was a long-term capital management, and Thailand said, sorry, we're going to devalue the baht. Oh, gee, I borrowed dollars and invested in Thai assets. Now they're worth half. Get me out of here. They dumped everything. Then that spread to Malaysia. That happened to be pretty well acquainted with Dr. Mahathir, who was prime minister at the time. He had some interesting stories to tell about that. Then Indonesia, then South Korea by the fall of 1997. And the old expression by when there's blood in the streets. Well, sadly, there was real blood in the streets in Korea. There were riots and people were killed, and then it cooled off a little bit. And then up pops Russia by April. And then that came to a head in August of 1998, and the whole world was waiting for Brazil. Brazil was the next dominant. Like I said, Thailand, Malaysia, Indonesia, South Korea, Russia. Here comes Brazil. No, here comes long-term capital management. We were like a country in terms of size and leverage and all that, and that became the epicenter of the crisis. And, of course, I negotiated that bailout, so I had a pretty front row seat. My wife remembers if I got any sleep. A lot of people didn't sleep for 5 days, but I said, I got at least 2 hours in here because I got to make decisions. And one night, I went to bed at 1 and I was going to get up at 5, but at 3, the phone rang. It was the Italian finance ministry. They were looking for some information on some unsecured loan agreement. They happened to be, and we were the biggest holder of Italian government debt. I took the call, and then she said, well, when you were done, you went right back to sleep. It took you 2 seconds to fall asleep. That's how crazy it was.